All right, on today's edition of Money Matters, we're going to learn more from our financial expert, Barry Watts, about what to expect from the downturn in the stock market that, I know we talked about this before, and if you follow statistics, things like this, it's imminent.
It sounds like it might be. Now, the market bounces around pretty much every day, so how do we know the difference between just a normal fluctuation and a true bear market?
Well, unbeknownst to any of us, today's the perfect day for this conversation.
Is it?
And you started the show with beer, and that's appropriate for two reasons, perhaps. First of all, the Dow Jones Industrial Average set an all-time high today at the closing. And so you might want to celebrate. But you also may want to keep a little of that alcohol around for later, because that's just one more indicator or harbinger of things to come to tell us that we're headed in the other direction at some point.
And the hype around the 17,000 probably doesn't help, does it? Or does it? Because some people say, ooh, 17,000, let's get in. Could make things worse in the long run?
People do things at the wrong time, that's correct, and they've all forgotten, it seems, what happened back in 2007 and 2008. And so what we want to do is anticipate those things and realize that trees don't grow to the sky, and what goes up does come down, and we're delighted with where we're at, but there are some things that we need to begin thinking about in order to protect ourselves from the bear market that is to come.
What are those things? I mean, what are the indicators?
Well, the definition of a bear market is a 20% downward move. So, the S&P, for example, bounces around every day as the Dow bounced up today. But until it's down 20%, we don't consider it officially a bear market. There have actually been 16 confirmed bear markets since the Great Depression, and we've got a visual, I think, that'll show you that. So it's kind of interesting. You can look at each of the bear markets and see the duration of the bear market, when it occurred, how far the decline was, and how long it took to come back to break even. And you can see that that can be a prolonged period of time. On average, it takes about 70 months to go from one side of the canyon to the other.
Is the fall, does it tend to be rapid? Because I know when we were looking at that chart last week, that growth line is so slow, but it looks as though you almost fall off a cliff.
It's kind of like falling out of bed and then struggling to get back up. And so what we want to do is protect ourselves from that fall out of the bed, because we don't want to spend and invest a lot of our time waiting on the recovery. So the question is, how do we protect ourselves coming out? Well, one idea, just an idea, we're going to talk about whether it's a good one or not, is that you own nothing but big blue chip companies, the biggest companies in America, brand names.
What could possibly go wrong?
Yeah.
That's exactly right. How could it be wrong if you own the biggest names in America? Well, we've got a little chart that talks about that. So let's put up that graphic and take a look at it. You'll notice there you can see Coca-Cola, General Electric, Home Depot, AT&T, Microsoft. I think the worst of those, if I recall, is Hewlett-Packard at some negative 80%. My eyes aren't as good as they used to be, so I can't actually see it from here. But the point is, owning the big blue chip companies doesn't necessarily work like you think that it ought to. No, and those are just the facts. That's simply what happened during the last bear market of 2007 to 2009.
Okay, so what do you do to protect you? I mean, if you can't go with the tried and true, the IBMs, the AT&Ts, things, what do you do?
And you don't want to necessarily bail out altogether, so how do you defend yourself?
Yeah, that's exactly the point. I think the first thing to do is to begin trimming your holdings and moving into a cash position. Right now, I like 50% cash. That's where the people that I advise are invested currently. 50% in cash, 50% still in good equities with strong relative strength. We talked a little bit about that last week. If you don't know what relative strength is, do your homework, or be sure your broker's done his homework so he can point you toward those companies that are ranked either 4 or 5 in the relative strength chart. That's an important step for you to take. And then finally, look for some guarantees. There are guarantees available, not very many of them. You have to understand them because there's all kinds of details on how those guarantees work. But it's important to look for guaranteed investments during times like this, because the bear will take it away from you, and you don't want to be crying in your beer during beer week.
No, not so much, if we can keep from it. So anyway.
Barry, thank you again. Appreciate the advice. Now, if you have a question or topic for Barry, to talk about, just email moneymatters@color10.com, and we may answer it on the next edition of Money Matters. Again, thanks for being here.
Delighted to come. Thanks.